Hello everyone, welcome to another episode of Financial Tidbits, here with me Royston at NOF. Today's topic is interesting as I will show you how you can essentially double the yield of a sin stock using a simple strategy. The stock that we'll be looking at today is Philip Morris. To some, Philip Morris is considered a sin stock that they will not engage with a 10-foot pole. Well, this is a cigarette stock that aims to achieve a smoke-free future. Yes, you heard me right. This is a tobacco company looking to destroy its own traditional business model. Say it is succeeding and the market is loving it. Philip Morris is a stock that currently has a dividend yield of approximately 5%. An overseas investor like us Singaporeans typically have to pay a dividend withholding tax of 30%, turning a 5% yielding stock into one that yields just 3.5%. Not so sexy anymore. However, do you know that one does not need to pay any dividend withholding tax on a special stock like Philip Morris, and an investor gets to enjoy that full 5%? This is because Philip Morris belongs to a special category whereby the bulk of its operation is outside of the US. More than 90% in fact, and hence the dividend withholding tax criteria is not applicable in its case. Thus, an investor buying into Philip Morris will get to enjoy its full 5% yield without paying tax to the US government. That is awesome. But do you know what is even more awesome? I will show you a simple strategy to turn Philip Morris 5% yield into 10%.
Oh, really?
But before that, let me give you a brief introduction on Philip Morris' operational outlook and how this tobacco company is looking to achieve a smoke-free future. Philip Morris is a cigarette seller with well-known brands such as Marlboro and Benson & Hedges. The bad news is that cigarette sales is on a structural decline as the world envisioned to live a healthier lifestyle. Instead of waiting for its demise, the company developed a next-generation cigarette called IQOS, which stands for I Quit Original Smoking. IQOS gives the same nicotine high feeling but with less dangerous side effect, according to the company. Whether that is true is not up to me to debate. But what is real is that demand for its IQOS product has been phenomenal, and the company is still just scratching the surface in terms of global product penetration. So, the company is touting this revolutionary product as the one to bring a smoke-free future to the world. Time will tell if this product is indeed the special one. Coming briefly to its financials, the company reported net profit has actually declined over the past decade from 8.5 billion in 2011 to just 8 billion in 2020, a 6% drop. But what is interesting here is that the company's earnings per share, or EPS for short, has actually grown from $4.85 to $5.16, or a 6% increment. What is happening is that the company has been buying back its shares over here. Thus, while net profit declined on an absolute basis, when divided by a much smaller denominator base, its EPS turns out to be higher. Now, some would say this is just financial engineering, although it is not likely to rival that of what Singapore Airlines has been able to achieve with its MCB offering. Share buyback to boost EPS is very common for US companies and is also seen as an indirect method to return capital to shareholders versus the more direct method of paying dividends. Philip Morris is doing both, paying a juicy 5% yield while at the same time committing to more share buyback. The company said it plans to implement a 3-year buyback program of between 5 billion and 7 billion beginning in the second half of 2021, which could boost its EPS by as much as 3% in 2023 just by this corporate action alone. So, I provided a brief operational background of Philip Morris. let's now talk about how an investor can double its 5% yield into a 10% one. This strategy involves the usage of options or call options to be specific. Today, if you are a proud shareholder of Philip Morris with at least 100 shares of the stock, you can engage in this strategy called a covered call selling. This covered call selling strategy entails owning 100 shares of a stock while at the same time selling one call option contract on the counter. Say, for example, you purchase 100 Philip Morris shares at its current price of $100 per share, which amounts to an outlay of $10,000. Concurrently, you sell a call option on Philip Morris with a strike price of $105 for a contract duration of 6 months. What does selling a call option at a strike of 105 means? This means that if Philip Morris price is above 105 after 6 months, you are obligated to sell your 100 shares at $105 per share. If that happens, that means a 5% return over 6 months or a 10% annualized return. Not too shabby. If Philip Morris price remains below 105 after 6 months, you get to keep your 100 shares of Philip Morris and the call option which you sold expires, which again allows you to sell another call option. Now, what is so good about selling call option in this scenario? You see, as a call option seller, you get paid a premium upfront. In this particular example, selling a call option with a 6 months horizon at a strike of 105, you get paid $2.50 per share or $250 per option contract. This equates to a synthetic yield of 2.5% over 6 months or 5% annualized. By structuring a covered call strategy on Philip Morris, you own 100 shares of Philip Morris which entitles you to a 5% dividend yield, and through the call selling action, you are entitled to another annualized yield of 5%, which essentially doubles your total yield position to 10%. Do this for 10 years and your Philip Morris shares becomes free. A covered call strategy is particularly useful for a stock like Philip Morris, one where you don't mind owning the stock for its high yield while at the same time generating passive income from the call option selling strategy. This also takes into consideration that Philip Morris, which is seen as a stable and boring stock, is not likely to trend much higher in the near term, unlike trending stocks such as Nvidia and Microsoft. For strong trending stocks, a covered call strategy might result in premature exit with substantial upside left on the table. With that, we have come to the end of today's financial tidbit, which I hope that you have enjoyed and learned something new in the form of a covered call strategy to juice up the dividend yield of a dividend stock. If you enjoyed the video, do leave a comment below, hit the like button, and sign up for the NOF YouTube channel. With that, this is Royston signing out.